Okay, students, now start the class. So today is the third unit, that is the factoring, forfeiting, and securitization. Three sub chapters. One is the first, under unit number three is the main. Under that, three sub units or sub lessons like factoring, forfeiting, and securitization of the debt. These are three chapters today. Go our class. So, what is the factoring? So, factoring, what are the need for learning these factors? So, in the objectives of the factoring is educate the factoring and evaluate the various types of factorings and assess the advantages and limitations of factoring and review the terms and conditions of various types of factoring agreements. This is the objectives of the factorings. Now, first of all, what is the factoring? The term factor as is a origin from the Latin word. What is the meaning of the this factoring? Make or to do. This is the meaning of the factoring. Make or to do. This is the definition of the meaning of the Latin word the factors. To get the things done. As per this definition of the factor, as an agent and particularly a mercantile agent, factoring may be defined as a accounting agreement between the financial institutions or banks and other business concerns. The purpose of selling of the goods or providing service on credits. This is the factoring. What is the definition of the factoring? A continuing agreement between the financial institutions or banks and a business concern, the purpose of selling goods or providing services on credit basis. This is the definition of the factoring. So, factoring in Indian economy as a witness amount of reforms after the new economic policy uh, initiated in 1991, there is a good amount of growth of economy, witness a continuous in the process of industrialization. This is the firm across have been facing the sale in the case of the business of a business to business holders on or a credit basis. Okay. Next is the functions of the factors. Functions of the factors. The it is a number one is the financing. First point is the financing. Then second one is the sales ledger administration. Then third one is manage the bad debts and advisory. These are four functions of the factoring. What are they? Number one, financing. Second one is sales ledger. Third one is the managing the bad debts. And fourth one is advisory, like suggestions. These four important functions of the factoring. What is the financing? Financing is the fund provided by the providing finance against the credit sales invoices or bills receivables or a trade debitors. So this is the financing. Then second one is sales ledger administration. The factor may also undertake the responsibilities of a sales ledger administration of the client, including maintenance of books. So it will take the additional work is a maintenance of the books, accounting, assets, a management, and collection of debts and other etc. works. This is the maintenance of sales ledger or sales ledger administration. Next, manage the bad debts. Manage the bad debts means to help the reduce the bad debts. Manage the bad debts means here to reduce the bad debts of the client by providing debt insurance facilities and possible losses recovered by the customers, and it is a help to the if it is a control the insolvents or other problems. Next, advisory. Fourth point, advisor. What is the advisory? Offering relevant consultancy services in the areas of the finance or marketing, arranging at a credit limits of the debitors and evaluation of the credit worth credits and the
So
potential
small
debtors.
doubt, sir. Which one you are saying, sir?
Factoring, page number 86, unit number 3, page number 86. You have a textbook?
Yeah, sir. 7.2.
Yes. Not, yes. 7.2, the D pointer, the functions
Okay,
of the
sir.
factoring
Okay, sir.
evaluation.
Continue, sir.
Yes. Okay, now these are four important functions of the factoring. This is important 4 marks question, 8 marks question. Please stick it. Clear? Next. Next, how does the factoring works? Next one, page number 87. How does the factoring work? Factoring work is they are given page number 88. They give one diagram is there. The left hand side is the seller and right hand side is the buyer, and middle is the factor. Factor is the key role. It will help to the buyer and the sellers. Okay. Here, the major purpose of factoring business is the realization of the books debts arise due to the credit sales. Credit sales. As soon as a credit sales the transaction ends, it is a time for the factor step of the perform his duties. It became a difficult to in the if that factor were to perform the independently, they generally tie up with the seller and bankers and having the associate with the people associated with them operating between the seller and buyers. Seller and buyers. The diagram is there. So understand left hand side the seller is there and right hand side the buyer. The middle is the interlink up with the factors. Okay. So what is steps involved in the factoring work? Number one, first and foremost, the buyer places an order with the seller expressing the just 1 minute. The first point is first and foremost, the buyer places an order with the seller expressing his desire to purchase the goods. This is the first point. Then second one is on obtaining the order, the seller send the details of the buyer to the factor. This is second process. Then third one is on getting the credit approval from the factor, the seller arrives invoice and delivery of the goods to the buyer along with the notice. Along with the notice. This is third step. Then fourth step is the supplier will send a copy of the invoice to the factor that makes the necessary entries in their own books and the seller book. Next one is step number 5 is the factor then pay up to 80% or 85% depend on agreement and terms and conditions. Then point number 6 or step number 6, the factor perform a regular follow-up of the collection from the various buyers and makers necessary arrangements to collect the dues. Step number 7, the factor also send a monthly settlement statement of a transaction to the buyers. And if the amount remains unpaid after the due date, the factor recover the same from the seller in case of the factoring. These are 8 important points factoring works. These are 8 important works or steps in the factoring work. Next, here types of factoring. Here, types of factors. Based on requirements, a client and ability to extend the services by the bank for financing services from the legal aspects or factoring agreement. The major parties factoring agreement will be client and factor with the same involvement gets affected the customer or the client of the third party. Only two parties is there, client and factor. If any requirement, the third party also join this factoring work. An agreement factoring is a general agreement like other contracts of the purchase and sale of the goods. The important aspects of a mutual and free consent of the primary requirement, where the client and the factor agree to purchase and sell the debts of the client to the factor. So this is the agreement between the client and the factors. Next year, the following steps involved in the agreement of factoring. The following steps are involved in the factor agreement. Number one, there should be an offer to sell the book debts arising out of the credit sales by the client to the factors. This is the first one. Then second, the acceptance should be made by the factor. Okay. Next, third point is in case of default by the customer, in case of default by the customer of the client, the responsibility of such a irrecoverable debt to be decided by the contracts. Next is the fourth step is the right of recovery of money from the customer of the client to the factor to collect the money from the book debts only, not bad debts. Next is the factor may advance some money immediately after receiving the book debt or invoice from the customer. The details of such payments and charge thereon. Next, the client may notify the customer that the remittances have to be made to factor into a specified accounts. Next is the step C is one more important point is the general information of notice of credits allowed to customers by the clients. Okay. Next, if any case, any warranties for the products sold and other as a required covenants. Next is the factor commission charge for the credit extended fee for any other service provided by the factor to the clients. Next is the duration of the agreements between factoring and client of the factor, or factoring between the agreement between the client and the factor. Once again, duration of the agreement of the factoring between two persons. One is the client, then second one is the factor. Next, in the terms and conditions, termination of the contract in case if one of the parties will like to come out of the agreements as per the terms and conditions. In case any disputes between two parties and the legal support is required, what will be the jurisdictions? If any dispute between the two parties means client and factor, and the legal support is required by the judicial aspects. So this is the important points under agreement. Next is the various types of factoring services. What are the services given by the factoring? So number one, notified factoring versus unnotified factoring. The services given by notified services versus unnotified services. Second point is domestic factoring factoring versus export factoring. Notified, unnotified, domestic, export, full factoring, whole line factoring. Next, fourth one is recourse factoring and non-recourse factoring, advance factoring and maturity factoring, invoice discounting and bank participation of factoring. These are the types of the factoring services. provided by the factoring. Now, number one, non-factoring, notified factoring and unnotified factoring, domestic factoring and export factoring, full of factoring and world line factoring, recourse factoring, non-recourse factoring, advance factoring and maturity factoring, invoice discounting and bank participating factoring. So what is the notified factoring? In this type of contract, the client of the factor does not notify the customers that the cash needs to be remitted to the factor on the date of the maturity or after the due dates. This is the first one, notified factoring and unnotified factoring. Then second one is domestic factoring and export factoring. All other things remaining constant, we can understand the form. It's a title. Domestic factoring is an agreement between client and factor within the country. Okay, so this is a domestic, but it is simple term, a situation where both the buyer and seller belong to the same country. This is the domestic factoring. Next, second one, in case of export factoring, the client and the seller are four factors where the customer of the clients are situated in a two different countries. The mode of payment is different. In domestic company, payment is the same, but one is next one is full factoring or worldwide factoring. What is the fundamental? This type of the factoring is called as full factoring because the client request for the all services that the factors extend with the factors extend with the 1 minute. 1 minute. Yes. Next one, the full factoring or worldwide factoring. Fundamental, this type of the factoring is called a full factoring. And because the client requests for the all services that the factor extend with the agreement, including the services of the collection of the receivable, maintenance of the sales ledger, and credit control, financing, and credit protection. Next is the old line factoring. Old line factoring means the factoring assumes the risk of the insolvency of the buyer. He closely supervises the buyer credit worthless and arrives at the credit limit before the agreement with the factor their invoices. Next is the recourse factoring and non-recourse factoring. What is the non-recourse and non-recourse? The agreement of factoring is between the factor and client that the client will sell on credit to its customers and accounts receivables are transferred to factor for collection on the due dates. So this is the recourse factoring. And what is the non-recourse in factoring? It's called the recourse factoring because the factor has recourses to recover such a money from the clients who he has advanced. Next. Okay. The factor has a recourse to recover such a money from the client whom he has the advance. If the factor has agreed to bear the losses of a bad debts and no right to get back the client, it is known as the non-resource factoring. Next is the next method is advanced factoring and maturity factoring. What is the advanced factoring? In advanced factoring agreement, the factor agrees to pay 80 to 90% of the value of the invoice or accounts receivables to the client on a continuous basis, for which the factor will lay interest. The client has agreed to the terms and conditions. This is the advanced factoring. Next is the maturity factoring. In agreement, in the agreement of the maturity factoring, the client of the factor does not get any money, any amount immediately on the accounts of receivables. Okay, so this is the maturity factoring. Next is the invoice discounting. In this type of agreement, the factor purchases all or the invoices bought by the client at a discount with a resource in a general. The customer of the client is not disclosed about the agreement between the factor and the client for the collection. This is the invoice discounting. Next is the bank participation factoring. Bank participation factoring. Bank participation factoring, the client will go to the factor and seek the funding and sales ledger administration, where the factor may extend the funding of invoice to an extension of the 80% the value of the accounts receivable. So this is the bank participation. Further, the client can approach the bank funds on the balance of 20% of the receivables. So 80% of factoring and 20% receivable by the bank participation. Next, last one is import factoring. What is the import factoring? Import pack in this type of factoring, it is international trade. It may be difficult to estimate the credit worthless, and it is some cases a genuine of the client to export of the goods regarding the buyer. In such case, there may be agreement two factors belonging to the factor chain international where the exporters and the factor approaches members from the factors chain international evaluate the collect the receivables from the importer. So this is the important factorings. Here, how many important here? Number one is the types of factorings. Number one, notified factoring and unnotified factoring, domestic factoring and export factoring, full factoring or whole line factoring, resource factoring and non-resource factoring, advanced.
Business factory and mandatory factory. Invoice discounting, bank practicing factories, import, import, import factories.
Yes. Okay. Next. Next one is the advantages of the factoring. Advantages of the factoring. So what is the advantage of factoring for the business? It should be able to create a win situation for the both parties. There should be a benefit to the firm that is available the services, and well the benefits should follow the following points or advantages related to the factoring. Number one, liquidity. Then second one is the business growth. Next one is the reduction on loss in accounts of bad debts. Next, unsecured facilities. Factoring is off a balance sheet. Factoring is an off balance sheet. Next one is the improves the commercial competitions, and factors is continuous agreement. These are seven important advantages is there. Number one is the liquidity. What is the liquidity? Liquid, the client of the factor who sell the goods on credit to his customer have accounts receivables on the balance sheet, and the same will be converted into the liquidity, cash and account. So this is the liquidity. Then second one is business growth. Business growth means the client need not worry about the collections of the cash from the accounts receivable. The responsibilities of the sales ledger administration, collect the cash, risk of the bad debts, etc., is taken by the factor. This is second advantage, the business growth. Then third one is reduction in losses on accounts of a bad debts. So reduction in losses and recovery of the bad debts. Apart from the cost of investment in accounts receivables due to delayed collections, the factor will also ensure accounts and receivables of the client if any risk loss recovered by the then insurance companies. Next is the unsecured facilities. Unsecured facilities. Factoring is fully an unsecured facility provided by the factor to the client where the client is free from such irritations. Next is the factoring of balance sheets. Factoring of balance sheet. The agreement of the agreement facility factoring is of from the balance sheet and improves the cash cash position of the business. The balance sheet ratio is a liquidity for the client will improve an account of increase in the liquidity lending to better the valuation. Okay. Next is the improves of a commercial competitiveness. So you know the client ability to extend the credits for a uh, longer period time means a long term benefits enable better commercial competitions leading achievements are achieving the market leaders in the road. Last advantage is factoring is a continuous agreement. Factoring is a continuation agreement. The factoring agreement is not for a specific amount or invoice and extensible for the entire business with the country. So these seven important advantages of the factoring. This is also important question. Number one, liquidity. Then second one is the business growth. Third one is the reduction in loss on the accounts of bad debts. Next is the unsecured facilities. Next, factoring is off balance sheets. Next is the improves the commercial competition, and factoring is a continuous agreement. These important advantages of factoring. Next, then limitations. Here, some limitations also there in a factory. Number one, loss of contracts. Loss of contracts. Then second one is cost of factoring. Then nature of the business. These three important limitations of the factory. First is the loss of contact. The first and foremost issue is the client will deliver the goods and need not worry about the collection. And because of which is the client will not make any attempt to the connect with the customer. Then second point is cost of factoring. Cost wise, one needs to understand that the interest rates charged by the factor are bit higher than the cost of the debt borrowed for a working capital from the banks. Next is the nature of business. In case the business of a client is a high demanded where the customers pay in the advance to obtain the products or services, factoring may not be facilities there. Okay. Next, these are important limitations of the factoring. Next, second chapter is second one is forfeiting. Forfeiting. So forfeiting is a here important. This is also important. So here forfeiting. Second sub chapter. This is second sub chapter. What is the meaning of forfeit? Forfeit means derived from the French word. What is the meaning of forfeit? Forfeit means surrender of the rights. The definition is what is the forfeiting? Means surrender of the rights. It is a simple approach to finance receivables of exports. It is a simple example to related to it is a simple approach to finance receivables of a exports. Forfeiting is a method of purchasing of the negotiable instrument from the seller exporter at the discount which had supplied the goods to the buyer importer. So the in other countries, so this is a export import. Exim, it is an import. Key role is the Exim Bank. Exim Bank means export business and import business. Next is the importance of the future, important of the forfeiting. What is the importance of the forfeiting here? Primary, the exporter is worried about the cash to be received after the goods are received by the importer. Suppose we have goods purchased from the USA, we are paying to the in USA the currency means the dollars, but that the forfeiting taking the risk from customer side. Then second one is forfeiting is a non-resource transaction. Forfeiting is a non-resource transaction. Once the instruments is discounted by the forfeiter, the responsibility of collecting cash lies on the holder of the instrument. So this is also important of the forfeiting. Next is the inconvertible bank credits or export factoring. The exporter will receive only up to 80% or 85% of the value of the receivables only. Next is the one major important thing need to be observed is that the exporter need not show the amount so received as a source to fund or it does not impact the borrowing limits of the exporters. Next, the risk of currency fluctuation in another aspect which the forfeiting agency will take over the exporter in this case of along with the interest rate of fluctuation of the risk. Next, once the exporter discount the negotiable instrument with the forfeiter, he is free from all credit management issues and the other costs such as export credit insurance is overcome and not incurred if the exporter decide to go for the forfeiting. Next, the forfeiting is used for medium and long-term credit extended to the exporter and importer. Next is this is enough. What are the parties involved in the forfeiting? So in forfeiting is the major parties are involved. Number one, exporter. Exporter means a firm which may be the business for trade or manufacturing or services providing the same to the parties outside the country. This is the exporter. Then importer, a form of the or individuals are purchasing goods or services from another country with the commitment to pay cash after the certain credit period. This is the importer. Next, a domestic bank. Domestic bank means a bank with which the exporter has current account and the amount so received from the exports are credited into the account. Next is the foreign banks. Foreign banks means a bank which is importer has saving or current account and the amount to be remitted is challenged for the imports. Okay, these are four important points. Exporter, importer, domestic bank, foreign banks, etc. Okay, this is also important. This is 8 marks question. Next, mechanism of forfeiting. Mechanism means functioning, like working. Like first one is the exporter should approach a forfeiting agency to understand the cost of the forfeiting by the export goods to the importer. This is the first point. What is the exporter should approach a forfeiting agency to understand the cost of forfeiting by the exporting goods to the importer. Then second step is the cost of forfeiting. The exporter will quote a price for the goods or services for which importer. So this is second step. Then third step is once the agreement is complete, the exporter will ship the goods and obtain a bill of lading evidence of the shipping of goods, shipping of the goods. This is the third step. Then fourth step is importer bank will issue unconditional guarantee. The instrument can be in the form of letter of credit or promissory note or any other transferable documents. Next, step number 5, the negotiable instrument with the unconditional guarantee is sent by the importer to exporter for further process. Next one is the exporter, after receiving the document, will give it to forfeiting the agency for discounting the paying the cash. Next is the forfeiting agency will discount the negotiable instrument as per the earlier code and remit cash to the exporter bank. Next step is on the date of maturity, the forfeiter will present the document for collection at available bank or guarantee bank, etc. Next step is the importer remits the money at the available or available the bank honor to the negotiable instrument given by the exporter to the forfeiting of agencies. Next is the cost involved in forfeiting. Cost means fees, like how much of fees. Here, three types of fees is there: commitment fees, and discount fees, and documentation fee. The forfeiting charge the three types of charges or costs. Number one, commitment fees, discount fees, and documentation fees. What is the commitment fees? So, forfeiting agency will will charge the exporter a commitment fee for the commitment made to discount at a specific rate within a specific period for an export transaction between 0.5 to 1.5 percentage per annum. This is a commitment fees. Commitment fees is minimum is 0.5%, maximum is 1.5 is the and export value. Then second one is discount fee. Discount fee means that the exporter, while obtaining the code from the forfeiting agency, will communicate, extract amount of exports that the firm is going to make. So this is the discounting fees. Next is the documentation fees. Documentation fees is charged for the uh, per transportation transaction. It is depend on the transaction value, legal formalities, and not legal, the completion of the legal charges. Okay, this is the documentation fees is the low. And next is the advantages of forfeiting. Advantages of the forfeiting. What are the advantages of forfeiting? The process of forfeiting enables to transfer the risks involved and international trade transactions to the forfeiting agency, and apart from providing the liquidity immediately. So this is was first advantage is forfeiting agency initially provided a quote with a fixed rate of discount. So that the rate at which it discounts the bill, and hence it is a fixed rate of finance. Fixed rate of finance. Next is the forfeiting agents will simplified simply discount the negotiable instrument and the non-reserve recourse recourses basis. Next one is the cash received immediately from the forfeiting agency result in the business liquidity. Next is the burden of managing accounts of receivables for exports and collection of responsibilities are transferred to the forfeiting agency with a high concentration on the business for the exporter. Next is the risk that exporter is free of our risk of our currency, fluctuating interest rates and movements, etc. There is a uh, there is a flexibility in the deciding upon the each transaction different by the exporter for forfeiting as each transaction is separately forfeited. Next, it is a simple process once the negotiable instrument is received by the exporter, it is discounted by the forfeiting agencies. Next is the last advantage is it is a important that the exporter obtain an advance option to the finance at a fixed rate from the forfeiter, and limitations is there. Number one, the exporter has a responsibility of getting a negotiable instrument with the unconditional guarantee obtained by the importer. Then second point is second limitation is the exporter may have a difficulty in encouraging that the importer can obtain a guarantor a satisfactory to the forfeiting agency. Next, one more limitation is a forfeiting is a uh, costly affair because forfeiting agents is taking all risks of the receivables, administration, and currency fluctuations and interest rates, etc. Interest rates and etc. Okay, these are three important limitations of the forfeiting. Next year, the difference between factoring and forfeiting. Here we learn today is our topic is first is the for factoring, then second chapter is the forfeiting. What are the difference between factoring and forfeiting? So some similarities like differences between factoring and forfeiting. The factoring agreement is a continuation one with the invoice raised by the client getting the transfer to the factor, whereas forfeiting factor transfer of factor. This is the factoring. Under forfeiting, whereas the forfeiting is for every single transaction is a separate one. So this is a factoring forfeiting. Then second point, second similarity between factoring and forfeiting. The factoring is for domestic sales as well as international trade. But under forfeiting, it is only international trade purpose of exporter. Then third point is factor provide funds into an extent 80% or 85% of the receivables. But here forfeiting is a one-time settlement with a deduction of the commitment fees. Next, factoring can be with the resource and without resource. But here forfeiting is only without resources only. Next, factoring can be undisclosed to the customer of the client in case of that is factoring. In the under forfeiting, in case of forfeiting, it is not required at all. Next is factoring. There can be bank participation factoring where in addition to the funds are provided by the factor. But under forfeiting, such a scope does not arise to at all. These similarities or differences between uh, factoring and forfeiting. Okay, this is also important question, students. Please check it. This is a 12 marks question, 8 marks question. Please tick it. Next, one more small chapters that is securitization. securities like a securitization. So what is a securitization? It is a simple term. Securitization involves the illiquid assets into the cash. Securitization is a process of conversion of the illiquid assets as a assets cash balance. It is a effect in balance sheet asset side. In the process of securitization, the originated company will pool the assets on the balance sheet. That's enough. Okay. Next, what are the parties involved in the securitization? There are two major stages of the securitization. First is being the originator pooling of all assets. Then second one is and it is bankrupt to remove the special purpose of vehicles to get into the cash. Okay. Next, what are the steps involved in the process of the securitization? First is the originator. So the first and foremost in the entire process of the securitization is the originator who originate the pool of assets from the assets. This is the first one. Then second one is the borrower. The party or people to whom the originator has extended a loan or sold goods for which the amount is receivable from the borrower in the future and future. Then special purpose vehicle, SPV. SPV means here special purpose vehicle. In some places, it is donated as a special purpose entry. This party purchases the pool of assets and sells the securities in the market that are able to are tradables. Next is the facilitators. Investment bank, primary banks are with the companies, sell securities in the market. There will be specialized agency and investment bank responsible for the designing the securities on the basis of the cash flow arising out of the pools of the assets. Next, the credit rating agency. The securities so designed by the investment banker has to obtain a credit rating from the rating agency. Rating agencies. Next, the insurance. The special purpose vehicle, along with the investment banker, may go for the insuring the default on accounts, receivables, and the same insurance company takes the risk of the default from the borrowers. Next is the investors. Once these securities are floating in the financial market, the mutual funds, banks, insurance companies, asset management companies, and other will invest in the debt security. Next, credit enhancements provided. So uncertainty lies in the security purpose that is made is designed in securities. The financial engineers take the future of a cash flow and there could be a lapse to enhance the credit worthless securities and confidences. Next, banker or banker. When the borrowers repay their quoted period installment, the money is collected by the bank or originated to the remit to the special purpose vehicles. Next, stock exchange. The stock exchange of the country provide the platform for the debt securities sold by the special purpose vehicle upon getting the securities. Next, that's enough. Okay. Next, what are the eligibilities? Eligible assets for the securitization. Which type of assets are eligible for the securitization? So number one is generally the assets of accounts are receivables like automobile loans for two-wheelers and four-wheelers and commercial other vehicles are related to the eligible for securitization assets. Next, there should be cash flow will be arise the future and account loans lent by the banks and financial institutions, firms are selling products. Next is that the rating agencies will look on the past recorded and promptness of the installments in the providing period to estimate the probabilities. Next is such assets pools need to be large enough to make the process of the certain securities and sale of the same in the market economically viable viables. That's enough. Next is what are the advantages and limitations of the securitization? So the in uh, globalization, securitization is a very play a important role in the financial system and emerged and the process of the using securitized instruments followed by the banks, the technology and others. Next, what first advantage? What are the advantages of the securitizations? The first and foremost advantage for the firm, the financial institutions and banks is that they will get the liquidity from their illiquid assets held in the form of the receivables. Then there will be availability of liquidity and cash from the assets without raising the further source of the funds either in the form of the debt or equity. The firms, when convert their liquid assets into cash, need not depend on the convertible source of financial like debt and equity to manage the cost of finance. Next is the banks and financial institutions can improve their business without increasing the borrowings or capital in the liability side of the balance sheet. Next is the ratio of the liquidity and dependence on banks for working capital will go to the go do, will go down. Next, the investors can invest in the assets backed securities with a greater confidence and lesser risk. And next for advantage is credit enhancement provided by the originator by the purchasing up to 20% of the securities sold by the special purpose vehicle or by transferring the securities in the senior debt and subordinate debt. Next, the investment companies in individuals will have the opportunities to diversification and the portfolio with another debt instruments. Next is the finance loss advantage. This is the third one is the financial system with more and more instruments and institutions is said to be efficient and vibrant, supporting the overall development of the economy. These are important advantages of the securitization. Here also some limitations is there. There are many advantages to the firm, but bank, financial institutions, investment companies, financial engineers, investment banks, listing firms, and other economic sectors. But some in there a few limitations is there. The number one, the firm originated the assets need to be careful in picking the assets that can be secured and the process through the increased liquidity. Next is there is a possibility of losing control of some business assets leading to disadvantage. It costs the originating the firm significantly if the originating firm wants to take back assets and close the special purpose of vehicles. So these are three important limitations of the securitizations. Next, okay, yes.
Sir, I have one doubt, sir.
చెప్పండి.
9.3 important కాదా, sir?
9 point
Assets back 9.3 assets backed అది.
ఓకే, ఒక్క నిమిషం. అసెట్స్ బ్యాక్వర్డ్ సెక్యూరిటైజేషన్ వేరే అంత అవసరం లేదా మీది?
ఓకే. 9.5 సార్, స్పెషల్ ప్రాసెస్ వెహికల్
అవసరం ఆల్రెడీ వచ్చేసింది కదా. అవసరం లేదు, 5 marks పేరు అదేమంత అవసరం లేదు.
ఓకే సార్.
ఇంకా ఒకవేళ ఛాన్స్ ఉంటే ఇది చూసుకోండి. ఇది మనకి ఇంపార్టెంట్. ఇందులో ఈ రోజు చెప్పిన చాప్టర్స్ లో ఫస్ట్ ఉంది కదమ్మా ప్రాసెస్ సెక్యూరిటైజేషన్. ఇప్పుడు స్టార్టింగ్ చెప్పండి. ఇక్కడ చాలా ఈ రోజు ఇప్పుడు దాంట్లో స్టార్టింగ్
చెప్పండి సార్.
ఈ రోజు చెప్పనా? ఓకే. ఫస్ట్ ఫ్యాక్టరింగ్ పేపర్ తీయండి. అందరి దగ్గర బుక్స్ ఉన్నాయా? ఓకే. ఫ్యాక్టరింగ్ లోది ఫస్ట్ వచ్చేసి ఫ్యాక్టరింగ్ ప్రైస్ ఒకటి. దానికంటే ముందు ఫ్యాక్టరింగ్ మెకానిజం ఉంది చూడండి. పేజ్ నెంబర్ 88 లో ఒక డయాగ్రామ్ ఉందా? 88 లో డయాగ్రామ్ ఒకటి.
5 marks.
8 marks. నెక్స్ట్ 7.4 ఇంపార్టెంట్. 7.4 ఓకేనా?
ఓకే సార్.
దాంట్లో నెక్స్ట్ 7.4 లో ఇక్కడ టైప్స్ ఆఫ్ ఉన్నాయి కదా, వేరియస్ టైప్స్ ఆఫ్ ది ఫ్యాక్టరింగ్, అదొకటి చూసుకోండి. అది ఒకవేళ 8 marks రావచ్చు, 12 marks రావచ్చు. నెక్స్ట్ అడ్వాంటేజెస్ ఆఫ్ ఫ్యాక్టరింగ్ ఒకటి ఇంపార్టెంట్ అమ్మా. అడ్వాంటేజెస్, లిమిటేషన్స్.
ఓకే సార్.
అయిపోయిందా? నెక్స్ట్ పేజ్ నెంబర్ మళ్ళీ ఇక్కడికి వచ్చేసేయండి. ఎంత? 102. ఇంపార్టెంట్ ఆఫ్ ఫ్యూచర్ ఫ్యాక్టరింగ్ ఫోర్ఫిటింగ్. అది 12